Okay, welcome back again, everyone. So now I'm recording the part 3 of the video. Hopefully this will be the last video, but again, depending on how much time I take on each topic, we have 20 more slides to cover. So the next learning objective we have is number 4, looking at the elasticity of demand and its impact on the price. So in the price elasticity, what we're doing is we're looking at the relationship of change in the price with change in the product quantity. So sensitivity of sales to a price increase is called price elasticity of demand. When small increase in a price result in a large decrease in the demand for the product is considered to be elastic. Okay, so the same thing happens in the other way around as well. The small decrease in the price could result in large increase in the demand. Okay, so it could either way happens. That means the relationship is elastic. That means a small reaction in the price will have a big impact in the demand. If that is the case, that means the product price is elastic. So what you can do is, in that case, you can achieve a maximum profit by looking at the net margin. Okay, so in that case, what happened is that the margin in the revenue maybe when it's higher, the cost is lower. So in that case, you may want to achieve a maximum profit. It tells you what the price of the product will be to maximize your profit if you use the formulas that are discussed in this chapter. So what makes it elastic demand? So if you look at the arrows here, the size of the arrow tells you how much is the change in the price. So the change in the price is pretty small, but the change in the quantity or the volume of the units that you sold decreased with a major impact. So that means that we made a small increase in the price. The quantity sold decreased because it always has an opposite relationship. So in that case, what happened is your revenue is going to decrease with more impact. So in that case, a small increase in the price will have a huge impact in the quantity. In that case, the revenue is going to decrease with the higher portion. So it tells you that the product elasticity is, the product price elasticity, so it is a price elastic demand. Okay, so it has a higher elasticity in the price change in the price. The opposite will happen in the same situation. If I decrease the price, the quantity of that decrease will go higher. So that means that I'm going to end up with more revenue. If I decrease the price, the quantity of the product will go up as well. Okay, so that means that it doesn't work only in a one direction. It works in the same way for the decrease in the price as well. What makes it the product less elastic? It means that if I change the price, so that means you see that I change the price big time, but the quantity decrease with a small portion. In that case, the revenue will increase more. So that means in this case, it makes sense for me to increase the price because it doesn't have much reaction to my product. Okay, so that's where it's important to see, okay, well, the product that are less elastic, you may want to do, you can increase the price because the customer won't react too much. Okay, for them to have more elastic demand, there'll be two reasons. If the product is more of a necessity for the customers, so that means that they need to buy the product regardless of what the price is going to be. Okay, the other thing that may say is inelastic because there's not much competition. So if you're charging a price and you're still following the legal rules of changing the price, and the quantity is not changing that much, that means you're going to have a net increase in your revenue overall. So depending on which what your product elasticity is, you can decide whether you want to increase the price and how significantly the price increase will be. So if you're using a price elastic formula to maximize your profit, here are the two steps that you have to do. I'm not going to be asking to calculate these numbers in your test or in the quiz, but it's important for you guys to know how these elasticity work. So first step, it will be to find the elasticity by looking at the change in the quantity sold with the change in the price. If I'm changing a price by $2 per unit, how much of the quantity change will happen? Is it increase or decrease? Once you determine that, this ln represents the linear relationship, So there's a formula that you have on your calculator. I think it's on a scientific calculator. Once you find that, the second step will be what is the maximum profit that you can achieve, will be the price that you set up for maximum profit. Now what you do is you look at that velocity and then use this formula, multiply the variable cost. That tells you the profit maximum markup formula is going to be used, and then when you add a 1 to the markup before multiplying with this, that determines the profit maximum price. What will be the price that you would charge to your customer that will maximize your profit? Okay, you can apply that formula in this equation and you will see how this will be the product. So first step is to find what is the velocity. So here you come up with a negative velocity here, and then use that into the formula, and that tells you that this is the price that you have to charge to get your maximum profit. What are the additional factors that we have when we that affects your price? So here are the different strategies or the models that the company use when they charge the price. They're all legal, so the companies can use one of these strategies to set up their price. We'll talk about it. They are good theory questions for me to ask in a multiple choice situation. The first one is some industry charge different prices at different times to reduce the capacity constraint. Okay, so we all know that there are certain products, right, that are high in a demand in a particular month versus the other month. So and then when they use these strategies to increase the price, that's called peak load pricing strategy. So this kind of practice is mostly applicable for the product when they know that there are certain constraints. The constraints could be the constraints with the product or the constraints with the customers. So for example, the good example that I can tell you is the product such as certain clothes that are sold more in winter. So if I look at the jackets, right? So those jackets are mostly sold in the winter. So what they do is they may charge a peak price during the winter season versus the summer season. So in that case, they know that the demand is high, people wants to buy it, they may charge a higher price at the time when there's a more demand of the product. So these strategies called peak load pricing. The same thing that you can talk about is the ice cream, saying that there's ice cream shops, they may run more promotions in the winter because there's a lot of customers that are out there, but in the summer they may charge a higher price, or they may not discount the product because they know that there's a demand for that product. The other the strategy or the practice the company uses is called price skimming. The price skimming occurs when the higher price is charged for a product or service when it's first launched. So these kind of strategies are mostly used in this kind of environment, because the companies, when they are launching a product, they create a hype for a product, so that way there's customers who are ready, they create that hype, and what they do is when they launch that product, they purposely set up a higher price, and then what they call is the price skimming. So in that case, the companies will charge a higher price, and when that hype is down and the product is already launched, and what they do is then they bring the price down to meet the demand at that time. So I feel that the iPhones or Samsung, when they launch new phones, they use these kind of strategies. When they launch a new phone, they set up a price higher, and that's after 6 months when the hype is done and they know that people have already bought it, and they bring the price down before they launch another product or another phone that they may come in a few months. So that's kind of a strategy the companies use these days, because they know that they can create a market, they can create that hype for the product, and they can charge a premium price at the initial stage when the product is launched. The next one we have is the penetration pricing. So these kind of strategies are used by companies when they are launching a new product, or the company is new and they want to create a market for themselves. So in that case, what they do is they do opposite. What they do is they set up a low price purposely to create or increase the market share for themselves. So in that case, like when a new company comes in, they wanted to compete with the market. with the companies that's already there. What they do is they will set up a price which may be a reduced price, so that way they can capture some of the market that's already being captured by the other clients. The next one we have is a price gouging. I don't know if I'm pronouncing the word right. So is a practice of charging a price viewed by a customer as too high. So this is one of the strategies the companies use when they wanted to only focus or cater towards a one type of customers. Um the one company that comes in my mind that I can share with you guys is, I'm sure you guys heard this, Rolls Royce. So you don't see these cars a lot on the road because they set up the price too high, so that way they can only cater towards certain type of customers who are willing to pay the price for the services. So what they do is they purposely set up a higher price so they can maintain a certain type of standards, and then they will only launch a certain number of cars, so that way is that they maintain a higher demand, and then they can focus only to a certain type of customers they wanted to serve. Okay, so this is just one example, but I'm sure there's a lot of other companies that are out there as well that may use a similar kind of practice as well. Okay, uh, then we have transfer pricing. So that's something that we're going to get into more detail a little bit later in the chapter. So when the companies are selling the products and services within the organization, we call them a transfer pricing. There are different rules and regulation that we going to look at when the companies are charging the transfer prices. The next topic we have is a pricing in a non-profit organizations. So non-profit organizations, what they are. So non-profit organizations are the organizations that are run either by government agencies or run by the companies, but their objective is not to make profit. So their objective is always to serve their customers at either at a reduced price or at a zero cost. So in that case, when they set up the price of the product or the services they're offering, they have to look at different factors. The factors are not to make profit, but the factors such as where those costs are being covered by the agencies or by the government through funding. They have to reduce those costs to see what are the costs that are not covered, and they may just use those ones to set up the pricing for the services that they're going to perform or the goods that they're going to deliver to their customers. So it is a little bit complex to determine the price, because their objective is not to maximize the profit. So in that case, maybe we want to look at is, if the company has a product or services that they're offering, whether they're going to recover all the cost or recover part of the cost. So what they do is, when they look at the cost that they have to pay, which is net of what they received from the government, is what gets passed over to the customers. So the pricing of the product and services that the NFPOs are offering, it all depends on the company's objective and how they run the agencies or the NFPOs as well. So I'll give you a good example as, like, for example, I provide accounting and tax services to my clients. But when I set up a price for my services, I always look at how much time I have to spend and how much profit I wanted to earn from those services as well. But if I run a session, say, okay, I wanted to help some of the new immigrants and wanted to file their taxes, my objective is not to make a profit, but to provide a free services where I have to pay the cost from my pocket, or maybe what I can do is I can charge a minimum price just to cover the time that I have to spend to prepare the taxes. So it all depends as what the main objective is. But in that example, I'm not talking about the NFPO, but I'm providing services to cater towards the clients that you might want to serve. The other example that I can share with you guys is there's a lot of NFPOs that provide food to the shelters. So when they provide these food, their objective is not to cover the cost, but their objective is to provide services for the individuals who are in need of those services. So in that case, their objective is to serve those shelters and provide free food. So in that case, the price that they're charging to their customers is zero. But at the end, they wanted to make sure that the cost is covered. In that case, what they do is they look at what the food cost is going to be, and they look at the government agencies who's going to fund their costs, and to make sure they net out to zero. So in the future, if they are netting out to zero, that they will continue to cover the cost, they may charge $0 for the services or the food that they will provide. But the next year, say, okay, well, if they're not able to cover 100% of the cost, the government says that we're going to fund only 50% of the cost. Then what they do is they may sell that food to those shelters at 50% of the cost that they have to recover from them. So it will be done at a reduced cost. So depending on what the company's objective is and where the funding is coming from, they may decide what the pricing of the product is going to be. So another example they talk about is the tuition fees. So the company may have to cover the cost of the tuition fees. So in that case, what they do is they look at the cost and they reduce the price for either to provide subsidy services to the people or the families with a low income, or they may want to give grants that is being provided by the government or by the endorsement by the individuals or the companies, or they may want to pass on those reduced price to the individuals who do a higher performance in the institute as well. Okay, again, it all dictates on the strategies of the NFPOs. Okay, so I'm going to pause here and then we're going to talk about the next few things, which is the government regulation and the transfer price, and that probably be the last video. So I'm going to pause here and then we'll get started in part 2 in the next learning objectives that we left.